Hey friends, today we're diving into how S-REITs might actually benefit as recession fears grow and risk-free rates drop. Most investors think REITs are the last place you'd want to put your money during economic uncertainty. But I've got some compelling data from JPMorgan that suggests Singapore REITs could see a 15% upside from their September 2024 highs. I'll break down why lower interest rates, widening yield spreads, and defensive positioning might make S-REITs an unexpected winner in the current market. Hey friends, welcome back to the channel. I'm Iggy, and I've been covering topics like stocks, finance, CPF, and everything related to growing your wealth. The investing Iguana is ranked 8th in the 2024 Influential Tigers by Tiger Brokers, with over 768,000 reads and 53,000 likes. I've produced over 700 videos with more than 300,000 watch hours as of December 2024. I also focus on regional and world economy topics. Let's start with something that might surprise you, the dramatic drop in Singapore's benchmark rates. JPMorgan has noted a faster than expected 31% drop in 6-month Singapore benchmark rates, while the 1-month SORA has fallen 100 basis points to 2.4%. These aren't small moves, friends. They're significant shifts that could trigger investor rotation into defensive yield plays like REITs. Why does this matter to you as an investor? Well, when interest rates fall, yield-generating investments like REITs become more attractive compared to other options. Think about it. If you can get a solid 6.3% yield from REITs when other investments are yielding less, where would you put your money? But here's the kicker. JPMorgan is expecting a whopping 15% upside to S-REITs from their September 2024 highs. That's not just dividend income. That's potential capital appreciation too. Have you considered how this double benefit might boost your portfolio returns? Now let's talk about what's driving these rate changes. JPMorgan and many other analysts are expecting 2 to 3 Federal Reserve rate cuts by the end of 2025. Why? Because recession fears are growing. JPMorgan economists are highlighting a 40% risk of a U.S. recession this year alone. Remember how REITs typically perform when interest rates fall? Their borrowing costs decrease, which directly impacts their bottom line. For every 100 basis point fall in floating rates, S-REITs could see about a 4% increase in their distribution per unit, DPU. That's real money going straight into your pocket as an investor. Think about your own mortgage or loans. When rates drop, your payments decrease, right? The same principle applies to REITs, but on a much larger scale. With lower interest expenses, REITs have more cash available for distributions to unit holders like you and me. Are you starting to see why this might be a golden opportunity for REIT investors? Even in uncertain economic times, sometimes the market creates unexpected pockets of opportunity. For those of you who like to dig into the technical aspects, here's something interesting. The yield spreads for S-REITs are currently around 340 basis points. This is the highest level since March 2022, which, not coincidentally, triggered a rally in S-REITs back then. What's a yield spread? Simply put, it's the difference between what REITs are yielding and what risk-free investments like government bonds are paying. When this spread widens, it often signals that REITs are undervalued relative to safer investments. Right now, S-REITs are yielding about 6.3% compared to bank yields at 6.2%. But here's an important detail. Banks typically pay out only 50% to 60% of their earnings, while S-REITs are required to distribute at least 90% of their distributable income. This means REITs offer more predictable and usually higher cash flow to investors. Have you checked what Singapore's 6-month T-bill rates are doing lately? They've fallen to 2.75%, and the 10-year bond yield is at 2.7% as of March 10. When these safer investments yield less, the relative attractiveness of REITs increases. If you've been sitting on the sidelines waiting for a good entry point into REITs, these widening yield spreads might be the signal you've been looking for. Let's get specific about which S-REITs might benefit most in this environment. JPMorgan has highlighted several top picks, focusing primarily on Singapore-focused names. Capitoland Integrated Commercial Trust and Capitoland Ascenda's REIT are at the top of their list. These are large, established REITs with diverse portfolios that tend to be more resilient during economic uncertainty. Keppel DC REIT is another interesting pick with its focus on data centers, a sector that continues to see strong demand regardless of economic conditions. Fraser's Centerpoint Trust, which focuses on suburban retail malls, could benefit from the defensive nature of everyday shopping needs, and Mapletree Logistics Trust, which JPMorgan identifies as a laggard, might have more room to run as the market recognizes its value. Struggling to decide which REITs to add to your portfolio? Remember that diversification across different REIT sectors can help manage risk while still capturing the benefits of this potential rally. Not all REITs will benefit equally from falling interest rates. The biggest winners will likely be those with a high proportion of floating rate debt, such as CDL hospitality trusts. When floating rates drop, their interest expenses decrease immediately without having to refinance. REITs with a larger share of SGD-denominated debt, like Fraser's Centerpoint Trust, could see their borrowing costs trend even lower than what their managers have guided. This could lead to positive surprises in their financial results. Have you looked at the coupons for S-REIT bonds lately? They've fallen to a 3-year low of 3.2%, thanks to reduced spreads and a drop in 3-year swap rates. This means REITs can refinance their debt at lower rates, further improving their financial position. Before you make any investment decisions, though, it's worth checking each REIT's debt profile. What percentage of their debt is on floating rates? When are their loans due for refinancing? These details can help you identify which REITs might benefit most from the current interest rate environment. Now, I know what some of you might be thinking, but Iggy, if there's a recession coming, won't REITs suffer from lower occupancy and rental rates? That's a valid concern, and it's why I wouldn't call REITs a perfect hiding place during a recession. However, not all REITs are created equal. Some sectors and properties are more recession-resistant than others. For example, necessity-based retail, data centers, and certain industrial properties might see less impact from economic downturns. The key point here is that while REITs may face some operational challenges during a recession, the benefit from lower interest rates could potentially offset some of these negatives. It's a balancing act, and right now JPMorgan believes the scales are tipping in favor of S-REITs. Remember, investing is never about finding perfect scenarios. It's about finding opportunities where the potential rewards outweigh the risks. Could this be one of those situations for S-REITs? Let's zoom out and look at the bigger picture. What we're seeing is a potential rotation of capital into defensive yield plays as recession fears grow. This isn't just about REITs. It's about how capital flows through different asset classes as economic conditions change. When economic growth is strong, investors often favor growth stocks and cyclical sectors. But as recession risks rise, capital tends to flow toward more defensive investments that offer income stability. S-REITs, with their mandated high distribution policies, fit this bill perfectly. Think about your own investment strategy. Are you positioned to benefit from this potential rotation? Have you allocated enough of your portfolio to income-generating investments that might outperform in a slowing economy? This doesn't mean you should rush to put all your money in REITs, but it might be worth considering whether your current asset allocation reflects the changing economic landscape. To wrap things up, while recession fears are certainly concerning, they're also creating potential opportunities in the S-REIT space. The combination of falling interest rates, widening yield spreads, and defensive positioning makes S-REITs worth a serious look for income-focused investors. JPMorgan's projection of a 15% upside from September 2024 highs suggests there could be both income and capital appreciation potential in this sector. Whether you're already invested in REITs or considering adding them to your portfolio, now might be a good time to take a closer look. Remember that even in uncertain times, there are always pockets of opportunity in the market. The key is to stay informed, understand the underlying drivers, and position your portfolio accordingly. If you found this analysis helpful, hit that like button and subscribe for more insights on navigating these complex market conditions. And if you're looking for more detailed analysis on specific REITs, check out my video on These 5 REITs Are Beating the Rate Crunch. It's a perfect companion to today's discussion. What's your take on S-REITs in the current environment? Are you increasing, decreasing, or maintaining your allocation? Let me know in the comments below.